further ado, Mike, I would like to welcome you. Please, the floor is yours.
Thanks, Jeff. I hope everyone can hear me, because I know I was struggling to hear Jeff from time to time there. So hopefully whatever the technical bug was is fixed, or at least not affecting me. Can we go to the next slide, please? So this webinar is going to cover the key proposed revisions to the definition of public interest entity in the code. I'm going to run through the slides fairly quickly. I want to allow a bit more time for questions this time than we managed last time. So I'm going to go through the slides very fast. So we're going to basically cover these 6 areas: the overarching objective, the approach we've had to revising the PI definition, the proposed PI categories that are in the ED, what we see as the very important role of local bodies, the role of firms, and other matters. Next slide, please. Just very quickly, a bit of background. The drivers for the project: when the PI concept was first introduced into the code in early 2000, we adopted a very narrow definition and concluded that other than for listed entities, determining which entities should be PIs should be largely left to local regulators. Since then, a number of international regulators and bodies have encouraged us to think about defining the PI definition more broadly. At the same time, we heard some concerns from the SMP community that there were onerous independence requirements for smaller entities, and there were a number of queries about what was meant by listed entities, definitions of recognized stock exchange, regulated stock exchange, the increasing growth of secondary markets, etc. So the project was brought forward to provide some more clarity about the scope of entities that would be impacted by the new NAS and fees provisions in particular. Next slide, please. We had very strong coordination with IAASB at staff, Taskforce and Board levels. The IAASB met in July and November last year to discuss the PI project, and especially those aspects that might be relevant to their standards, including the overarching objective, the use of listed entity, and the transparency disclosure that's proposed in the ED. We move on to the next slide, please. To start with, we felt it was important, and the task force felt it was important, and the board subsequently agreed that it was key to have an overarching objective as to what it was we were trying to do when defining a PI. It's not about setting a different level of independence, but it is about determining for which entities, if you like, there should be increased requirements to provide comfort and assurance around that independence. And the IAASB was also broadly supportive of the idea of a common overarching objective for the additional requirements that they have relating, for example, to listed entities. So what is our overarching objective? Go on to the next slide, please. Effectively, we said there was significant public interest in the financial condition of certain entities. It was therefore important that there was public confidence in the financial statements of those entities, and confidence in the audits would in turn enhance public confidence in those financial statements. So the additional requirements are enhancing confidence in the audits, which will in turn, as I say, enhance confidence in those financial statements. Next slide, please. The focus is on the public interest and financial condition of an entity, not public interest of other aspects of the entity, regardless of how significant they might be. We wanted to make it link closely to the role of the financial statement auditor. Therefore, the proposal refers to financial condition. We use that rather than some of the narrower terms because we were encouraged to think potentially more broadly than just pure financial statements, although that is clearly the area in which the auditor is most involved. We also determined that financial condition could be taken as its literal English sense rather than having to be a defined term. As I say, we wanted to make it clear it was financial condition rather than other aspects of an entity which might cause there to be public interest in it. So, for example, for social media providers, there might be significant public interest in how they manage the collection, use and disposal of their users' data that contain personal and sensitive information. But whilst the financial success or failure of social media providers would impact their investors, there is only likely to be a limited impact on their users, given that providers are usually free to join and the actual providers are easily replaceable. Next slide, please. In looking at how to determine the level of public interest, we proposed a number of different factors. Nature of the business is key, I think, to this, and in particular where we have businesses which, as a matter of course, take on significant, potentially longer-term financial obligations to the party as part of the entity's primary business. So, for example, deposit-taking and insurance businesses. Closely linked to that, but not necessarily completely overlapping, is the extent that something is subject to regulatory supervision, which in itself is designed to give confidence that financial obligations will be met. Size is also a criteria. It can either be too small to be included or too big not to be included, irrespective of meeting some other criteria. None of these, I hasten to add, are designed to be exclusive criteria. This is a key factor, as the proposed list that we have in broad terms would at prima facie scope in quite a few smaller entities, and we expect that to be refined, as I'll come on to later, by local bodies to exclude them. Importance to the sector: the harder it is to replace an entity, the more likely it will have a higher level of public interest. This may be particularly relevant to public utility entities and financial market infrastructure entities. Nature is also relevant, e.g. institutional investors versus retail investors, and entities that might be too big to fail because of the impact overall in an ecosystem. Most of those would already be part of the financial systems and captured by the proposed list of pies. We go on to the next slide, please. We then had to look at what approach would best achieve the overarching objective we'd set ourselves. We determined quite quickly that we would not be able to come up with a global definition of pie. You only got to look at, for example, some of the EU regulations, which, whilst they have definitions which scope in quite a lot of things at a EU level, there are a number of exemptions which are generally applied at a country level to exclude certain smaller entities such as credit unions or some mutual insurers. And in addition, a number of countries have also then added to the list. So under a narrow approach, we felt it was difficult to refine the current definition and unlikely to meet the expectations of some of our stakeholders, who felt it was important that we should give more of a steer and indication as to what should be in a definition of pie. So we settled on a broad approach, but it had to be at a high level. So it's inevitably scoping in entities that frankly should be excluded. And we agreed that local bodies had the key role to play in tightening those broad categories as part of an adoption process. As I say, the choice was narrow or broad. There wasn't really an in-between option. So if we go on to that broad approach, as I say, we have set the role of the code is using some common pie categories, which we expect to be adopted by most, if not all, jurisdictions. The role of local bodies then is to refine that list, adding new types or exempting particular entities if they felt, for example, to be too small. We also felt that we wish to enhance the current application material in the Extant code to a requirement for firms also to determine if there should be additional categories of entities to be treated as pies, recognizing that it's difficult even for local bodies to always anticipate the nuances of every fact and circumstance that might actually make something a pie, even if, broadly speaking, the category to which it belongs is not. Go on to the next slide, please. So the proposal is expand the pie definition to 6 categories, which are set out in the requirement 14A to 14F. We set out to include those categories which we felt were likely to be adopted by most jurisdictions and were suitable for a global list because of the nature of their main functions. We determined to exclude categories that would likely, for example, be only included by local bodies because they're very large or for other idiosyncratic reasons. If you like, we played the 80-20 rule. Next slide, please. So the proposals expand the definition to 6 categories, one of which is merely an entity specified as such by law or regulation. So in other words, picking up the current extant code. But the 5 specific categories are set out here. So a publicly traded entity, an entity one of whose main functions is to take deposits from the public, an entity one of whose main functions is to provide insurance to the public, an entity whose function is to provide post-employment benefits, or an entity whose function is to act as a collective investment vehicle which issues redeemable financial instruments to the public. Go on to the next slide, please. So the first of those was determining that we would replace the term listed entity in the Extant code with this definition of a publicly traded entity, an entity that issues financial instruments that are transferable and publicly traded. That's designed deliberately to be a broader term than listed entity. There are, as I say, a number of additional markets that have set up where increasingly their entities are actually quite large and that's increasingly started to be as pies. And indeed, at Forum of Firms meetings we had last year, a number of firms indicated that they were treating entities that are on second-tier markets as listed entities. Financial instruments is also intended to be broadly applied, so it includes warrants, includes shares, it includes bonds. Publicly traded, we use instead of publicly listed. Some financial instruments are listed but not intended to be traded. There are a number of, for example, that I'm aware of, which are listed for tax reasons but held entirely intra-group and not traded. So we didn't want to capture those. We do assume there's some sort of facilitated public trading mechanism. In other words, people can buy and sell their shares without going themselves and seeking a purchaser in order to transact. We did consider whether we should try and capture those entities which were in the process of being listed on a local exchange, etc. But again, because the practices vary around the world, the timetables vary, we felt it was actually more appropriate for this being one of the matters for firm consideration, as they would know the facts and circumstances and therefore the timescale over which such a thing might happen. We did also have a brief discussion on whether, for example, entities raising funds through initial coin offerings or other innovative new ways of raising money would either be captured by our current definitions or need in some way to be separately categorized in the code, and we'd welcome views on that. We go on to the next slide, please. So the next two are pretty obvious. In shorthand, they're banks and insurers, but we try and come up with definitions that capture things rather than simply just use that term. And we did note that almost invariably, where banks and insurers are defined as pies in local codes, it's by reference to the legislation that defines a bank or an insurer in that particular jurisdiction. And that is one of the things that we would expect, again, local bodies to do as part of adopting the code, is to narrow the definition to those entities that are caught by that sort of legislation. We used, obviously, one of whose main functions, because most banks do things other than just collect deposits, and quite a lot of insurers do things other than write insurance policies. Banks, insurance companies and pension funds, as it says here, are also already cited as examples for firm consideration in the Extant code. And as I mentioned when talking about the EU, even some types of banks or insurance companies are explicitly excluded from PI definitions in various jurisdictions. For example, things like credit unions that might otherwise be caught. Go on to the next slide, please. In the next two categories, we went for whose function rather than whose main function. In terms of category D, which is retirement funds, pension funds of one description or another, the aim is to capture, it says here, both pension funds available to the public and those that are restricted to significant numbers of employees of specified entities. Again, we would expect a size criteria to play a part here. As I say, we went for whose function because we didn't want to include employers that also, as part of the contractual terms with their employees, offered post-employment benefits. Rather, it's the vehicle which, if you like, takes on that liability generally for quite some time after retirement. Category E, we were really just covering fund vehicles where investors can only realize their investments by selling them back to the entities. So mutual funds, unit trusts, and other similar closed-end vehicles. If a collective investment vehicle issues non-redeemable financial instruments, our thinking was it was likely to be a publicly traded entity in any event. And so for the last definition, it's drawn from the Extant PI definition and is really just designed to capture those that have been defined by laws and regulations as pies, but we have taken the opportunity to tighten it to make it clear it's with the objective set out in paragraph 400.9. Obviously, the term PI can be used in various ways, not all designed to be linked to financial reporting and financial auditing. Go on to the next slide, please. As we say in the basis for conclusions, we did consider other potential categories when developing the proposed definition, and for one reason or another, we didn't decide that on a global basis that they had sufficient public interest to be included specifically as a separate PI category, but we do acknowledge that some, or even potentially all of them in some cases, might be appropriate as a PI in a local code, and some local jurisdictions have already incorporated some of these in their local code. Go on to the next slide, please. So, for example, custodians was raised as a specific issue. Custodians obviously maintain assets on behalf of third parties, and in that role, they do actually command significant public interest in that activity. However, the client's assets don't generally feature in the custodian's own financial statement, and again, the role of the auditor who audits the financial statements vis-a-vis any assurance around the custody activities varies significantly from jurisdiction to jurisdiction and type of custodian. So again, given the complexities, we felt it not appropriate to include it as a PI category, but we would certainly encourage local regulators to think about it in their own jurisdiction. Next slide, please. In the same sort of way, public utilities, again, the structure of public utility services varies from country to country. If I take my own example, I think I'm on my third electricity supplier in almost as many years, because they have a habit of being started up, offering very cheap deals and then going bust because the deal's too cheap. That doesn't affect me one iota because it just gets picked up by the next supplier. And there are guarantees within the system to ensure that I never lose any money. So I take no notice whatsoever in the financial statements of those entities. So again, I think it will vary depending upon the amount of the structure will dictate the amount of public interest that there will be in such entities. So again, we haven't included it as a global definition. Next slide, please. Lastly, financial market infrastructures and stock and commodity exchanges. Again, the structure of these in various countries varies. Stock and commodity exchanges, a number of those are now listed entities in their own right and therefore caught by other categories. Some are mutual still and actually don't necessarily produce public accounts. If you take financial market infrastructures, again, the structure of those varies considerably. So the payment system in the UK is effectively backed by all of the major banks. So its own financial statements, which actually show a significant deficit, don't actually mean very much and aren't of much public interest. It's more important that the banks continue to support the payment system. So again, we decided not to include those at a global level. We go on to the next slide. We have covered a discussion on a number of these categories in the guidance that we produced earlier this month. Go on to the next slide, please. And this comes on to the role of local bodies, which, as I said, is key to the success of this. Let's be clear, if local bodies don't adopt the code, clearly we have failed. If local bodies adopt the code using the language as currently expressed in the code without seeking to refine it and make it clear what they mean in terms of the entities in their local jurisdiction, we will also have failed. Invariably, those categories are too broad for use within a local jurisdiction and will drag in a number of entities that should not probably be regarded as PIs. So as I say, we do think that that role of local bodies is key. We did circulate a questionnaire to about 50 professional accountancy organizations, Asia, Middle East, Africa, as well as Central and South America, via the IFAC networks, seeking views on whether or not in those jurisdictions they felt the local bodies would both have the capacity and the willingness to take on the task that we're effectively setting them. And we were very pleased by the answers. We got over 50% back, and they all almost invariably said that they felt that their local body would take that role on and would be up to it. And ultimately, of course, the PAOs have got a role to play here, because if there is a local regulator that does not actually do anything with the suggestions that we've got, it is perfectly open to the PAO to probably come up with a definition of pi to be adopted within their local code, even if it doesn't have the force of law. We do recognize that this is a challenge for local, sorry, I know I paused. Can we go back? We do recognize this is a challenge for local bodies, so we are suggesting a longer transition period, and we will be developing further non-authoritative guidance and conducting other outreach activities to ensure that this stands the greatest possible chance of being picked up. Next slide, please. These are a couple of the sorts of questions we expect local bodies to address. So a publicly traded entity, thinking about what secondary markets there should be there, should be included within the particular jurisdiction, what other forms of facilitated trading mechanisms there might be. Similarly, an entity in terms of deposits from the public, is there a definition of bank that can be used that's easily adopted by the code? And whether certain types of financial instruments, say such as credit unions or other mutuals, should be excluded. And I would encourage everyone on this webinar to play their part in trying to ensure that this proposal is adopted locally in a sensible fashion. Next slide, please. The proposals, as I said, do also include two new requirements for firms. One, we're elevating the current application material. So we can go on to the next one, to making a requirement to determine if there should be additional entities included as PIs. We've also put in some additional factors to assist firms with their determinations. So, for example, whether in fact the law and regulation specify something as not being a PI, because it would be perverse to then include it. Whether, as I indicated earlier, it's likely to be a PI in the near future, so whether it's going through listing, whether it's applied for a deposit-taking license, etc. Clearly, precedent has a part to play, both in terms of how the firm might have treated other clients, or indeed other firms might have treated that client. I do think it's appropriate to think about whether or not, if a firm asks to be treated as a PI because it wants to inspire that greater confidence in its financial statements, it's appropriate, I think, for the firm to consider that request. I don't think it's appropriate to mandate that the firm exceeds that request. An awful lot of the requirements within the IESBA code, and indeed in the IAASB codes as related to listed entities, rely on communication with those charged with governance, and implicitly assume that there is a sensible corporate governance structure within the organisation that allows those communications to receive the attention they deserve. So I do think whether the entity has that corporate governance arrangement is something which would play a part in the firm's determination as to whether to exceed that request. This is a requirement already included in the Australian and South African codes, and it seems to work reasonably well. Go on to the next slide, please. The last one is transparency. I'm a firm believer in transparency, those people who know me. And I do think transparency has got a key role to play here as well. We do recognize that because we can't have a globally consistent definition, there will be inconsistencies across the globe. We do realize that different firms may indeed adopt different criteria for what they regard as PIs in terms of the role they have to add. It's therefore, in our view, important that readers of the accounts readily realize whether or not something has or has not been treated as a PI for the purposes of the independence rules. So we are proposing a requirement for the firms to make that disclosure somewhere where it is easily accessible by the readers of those accounts. Finally, I just wanted to cover a couple of other matters. Related entity in particular. We had a long discussion, sorry, next slide. We had a long discussion about this. The Extant code currently really utilizes listed entity in the definition of audit client. So audit client for a listed entity includes all 5 related entity categories, upstream, downstream, sisters. Others, including other PIs that aren't listed, it's downstream only. We did consider whether the definition of audit client for listed entity be extended to all PI audit clients. But we felt on balance that actually there would be difficulties in that given the varying corporate structures that apply. So private equity complexes, sovereign wealth funds can be particularly difficult. And those difficulties were more about the nature of that group corporate structure than the nature of the entity itself. So we felt there was a need to consider this further, and therefore, to the extent it needs to be looked at, it would be out with this project. As an interim action, we did think about replacing listed entity with the new paragraph in 400.14a. We go on, and that is indeed what we have done. So we have replaced it with publicly traded entity. And as I say, we will look at the definition of audit client in R 400.20 as a separate IESBA workstream in due course. The very last bit I just wanted to cover off quickly, next slide, is we did undertake as part of this project to look at Part 4B of the code, but ultimately concluded that we did not need to revise anything in Part 4B because public interest in the insurance engagements has at least as much to do with the nature of the engagement as the nature of the entity, and therefore it was not really within the scope of this project to define what constitutes a public interest assurance engagement. Move on to the next slide, please. Finally, the IAASB has identified 3 key aspects that it will take on board, partly in terms of considering the responses to this ED, but also as its general work streams. One is, should they adopt the common overarching objective for additional requirements? Secondly, should their differential requirements currently only applicable to listed entities in the IAASB standards be applied more broadly to other PI categories, where they are proposing to look at that on a case-by-case basis? And finally, in terms of the transparent disclosure, would it be suitable to include that disclosure in the audit report? And they will consider that as part of their current auditor reporting PIR. Go on to the next slide, please. So I indicated we've gone for a long transition period. So we're looking at December 24, which is some 2 years after the NAS and fees effective date, because we felt that would give plenty of time for local bodies to adopt the code. Noting I would say that an awful lot of local bodies already have a quite extensive PI definition in any event, and it give us time to develop the guidance material and to help that adoption process. Next slide, please. So comments are due May the 3rd. We have now put out the supplementary guidance. It came out in March. I would encourage you to respond, please, on the various topics we have there. So the overarching objective, the general approach we have to revising the definition, actually what is in those categories, the role of local bodies and the role of the firms, and the effective date. And in addition, the matters for the IAASB consideration, which will enable them to take that on board as they approach their various projects. And that, I hope, gives a bit of time for questions and a bit more time than we had the other day.
Thank you, Mike. I hope everyone could hear me this time. Apologies again earlier. Had some technical difficulties with my internet. So we do have a little bit of time for questions. So I'll go right into it. First question, Mike. It's on the PI definition. Would mutual funds be considered as an IESBA PI category that would fall under one of the PI categories? That's our first question.
Yes, I think, as I indicated, that is indeed what one of the categories is designed to capture. Okay. We deliberately didn't use the term mutual funds because mutual funds, as I say, are used in some jurisdictions. Unit trusts are used in other jurisdictions. But effectively, the definition in E is designed to capture mutual funds.
Okay, thank you, Mike. Next question we have is, in jurisdictions where the PIs are specified clearly by laws and regulations, such as those in the EU member states, are local bodies still expected to refine the definition, the proposed definition?
And again, it were by local bodies here. We deliberately didn't say whether it is regulators, legislators, or PAOs. I presume, in effect, if there are the extended definitions, as somebody said, in EU countries, then that would largely have done the job already. I'm not expecting, for example, that this will have a major difference in terms of how things are adopted in the UK. But the role of the PAO, I think, is to think about whether or not there's something a regulator has missed out and therefore potentially ought to be included. And at the very minimum, I would expect the PAO to, in adopting the code for their purposes, refer to the local legislation that was in effect.
Thanks, Mike. A follow-on question by another participant, again on local bodies, is which local bodies would normally make such a refinement? Is it a government body, Ministry of Finance, or member bodies?
All of the above. It varies so much from jurisdiction to jurisdiction.
Yes, I was going to say
It's
that.
whoever has the role in the local jurisdiction primarily, but as a minimum, as I say, I would expect PAOs to align their code with whatever is adopted if it's adopted within law. And if there isn't a law, I would expect them to set it out and define it in their code.
Okay. Thank you, Mike. Another question, still on the PI definition and the different categories. Would not-for-profit organizations be included in the PI definition?
And you'll have seen, again, if you read the supplementary material, charities were considered in terms of whether we should have them as a specific additional category. The view we took is that we felt that that would be difficult because quite often it's dictated by size criteria when it comes for not-for-profit. And there's always a balancing act between increasing regulatory burdens on not-for-profit organizations and allowing them to maximize the use of their funds for their beneficial purposes. Having said that, we tried to frame the wording in the ED so we were not clearly excluding not-for-profit organizations. So we haven't set out to deliberately include them, but it would not surprise me if certain of them were included in various jurisdictions using the sorts of criteria that we've set out.
Thank you, Mike. Next question, you've sort of touched on this a little bit in the presentation. Did the IESBA consider whether cryptocurrency and blockchain technology companies should be included under the revisions of the PI definition?
Blockchain companies, no, because as far as I'm aware, they don't necessarily produce accounts, and certainly not accounts which would show anything about what their blockchain liabilities were. In terms of cryptocurrencies, then again, we did look at initial coin offerings. Interesting enough, we looked at the IAASB's definition around whether such ICOs were classified as liability or equity. And I think you might get different answers depending upon what side of that particular line you fell on. And again, you have to start off with, well, do some of these entities even produce financial statements that are widely available? So we haven't, as I say, we'd welcome views on some of this. If people have got particular examples, we'd be very happy to look at them. We haven't at this stage included a specific category, but that's not to say that local bodies, if they have a particular structure in their jurisdiction, couldn't do so. And again, it would come back to looking at the criteria we've set out. Sorry, Jeff, you've got internet problems again.
Yes, I have. Can you hear me now?
Yes.
Does the IESBA plan to distribute any guidance material for local bodies to train the accountancy profession?
It's certainly guidance material. As I say, we have issued some supplementary guidance material this month. In terms of the role of training, that's not something I think we specifically considered, but we would certainly be happy to discuss with IFAC what form that might take.
Thanks, Mike. Then I have a question more going back to the start of the presentation on the overarching objective and one of the factors. If one of the proposed factors is regulatory supervision, and if this factor doesn't exist for a category, does that mean that the local body would not need to include this category or would not need to consider this category as a potential PI?
I certainly think if something is not applicable, it's not applicable. So if there was a jurisdiction that had no form of regulation that met that criteria, I certainly wouldn't see any reason to be including it.
Thanks, Mike. Next, we have a sort of a two-part question, and it goes into the different kinds of types of, I guess, views out there in terms of what should be PI and what shouldn't be PI. As there is a possibility when implementing the factors to assess an entity, you might end up with different results. And of course, the local body or the regulators might have a different view to firms. And the question is, the first part of the question is whether IESBA will plan to simulate this condition, or what sort of plans we have or solutions we have to deal with these sort of differences in views.
Sorry, Jeff, I was slightly confused by the question. Do you mean differences in views between jurisdictions or differences in views between firms in a jurisdiction?
Between firms and jurisdictions, I think that's the question.
Again, I think transparency has got a huge part to play in this, because if some firms do treat certain entities as PIs and others don't, I think that will provoke questions. Similarly, if some jurisdictions adopt PI definitions that are seen to be more rigorous than others, that may provoke questions. So I don't think we can dictate, but I do think that through transparency, there's a lot of peer pressure that gets applied that over time will help build consistency.
Thanks, Mike. The next part of the question you sort of answered in part anyway, at least. Obviously, as part of proposals, we're looking at increasing transparency and reporting by the auditors and the audit firms, whether they've treated an entity as PI. So the question is, if the entity is of course supposed to know whether an audit firm has treated it as a PI or not. And from the entity's perspective, there may be a question to say firm A, why is treating it as a PI, but then a previous firm, say firm B, was not treating it as PI. So how would a firm go about explaining that to the client?
I'm sure there are more difficult questions that firms have to explain to their clients. I think, as I say, I think transparency is a key part to play. I think actually firms will be surprised in terms of companies wanting to be treated as PIs rather than wanting not to be treated as PIs, given it is all designed to enhance confidence in their financial statements. It might even be that you get more requests coming in from companies where it's not appropriate to treat them as a PI than the reverse way round. I'm not sure I can answer the question about how a firm goes around discussing issues with its client, but I don't see a big problem.
And I guess the question is also whilst there might be no change in the entity, I guess you would still have firm A and firm B potentially leading to different conclusions.
Yes, as I say, I think that over time, if there is transparency, that will coalesce around a view. It may be a view in a jurisdiction rather than a global view, but it will coalesce.
Great. Thanks, Mike. Next question we have, would local government entities be included in the definition, whether it's a state or city or even federal, Commonwealth?
Again, it comes back a little bit to the role that financial statements play within the construct of that government funding and government setup. I can imagine in a lot of cases they would, but not necessarily universally. Again, as I say, it depends a bit on the government funding and the structure, and indeed the role that the firms and the accountancy professions actually play in the audits of those entities. In a number of countries, it's actually down to some form of state regulated auditor to audit those. So they're certainly not, again, it's a bit like charities, they're certainly not excluded. We found it difficult to come up with a definition that would include the ones we wanted included without potentially including a lot of others.
Thanks, Mike. Next we have, it's an interesting question. Did IESBA consider whether to look at the public interest of an entire market that an entity operates in rather than the single entity?
No, for the simple reason that I think that you could have quite small entities operating in a market that was of public interest, and it wouldn't be appropriate to apply a pie category to that small entity, which if it did go bust would have little or no impact either on that market or more generally.
Mm-hmm. Thanks, Mike. Another question again is particular types of entity, and I think some of these might be best to answer at the local level anyway, but certainly I think it's good to raise some of these here as well. With international oil companies involved in crude oil explorations, if they're not listed entities, would they be considered as pies under the IESBA definition?
I suppose you'd have to look at some of the other criteria. I can imagine a number would. It may well be that some small private exploration companies which have got very little in the way of operations and very few employees wouldn't, because again, whilst it might be regarded as a public interest in the effect that they're having on the environment, that may, at this current stage of evolution, have not a lot to do with the role of the auditor. One of the things we did talk about was whether or not ESG type reporting would be something that should form a part of the consideration for whether something was a pie. I think when you move down the road and you have more standardized ESG reporting, and indeed a more standardized role for assurance providers around ESG reporting, that might be included, but I think it would be premature at this stage.
Thanks, Mike. Just to change gear a little bit, this question is on publicly traded entity. Is the term publicly traded entities, that definition intended to exclude where debt is held by private equity funds as well as within the groups?
Potentially, yes. I say potentially because it's whether it's held or whether it is actually traded, and if so, who it's traded with. We felt it appropriate to talk about trading rather than holding, because again, you can have a number of structures where shares might be issued as well as bonds, which are then held onto and are not really traded. And quite often these might be smaller entities where it wouldn't be appropriate to treat them as pies. So I think about, again, my own experience in the UK, we have a category of tax efficient investment called EIS, Enterprise Investment Scheme investments. They are startup, very small companies, which because of the tax structuring need to issue shares direct to their investors. But those investors are, if you like, managed by a manager who handles the investment on their behalf. So they're never traded. They are acquired ab initio, held onto for the requisite period of time, and then an exit route looked for. So we wouldn't wish to capture those sorts of entities in this sort of definition.
Okay, thanks, Mike. Next, we're going to the local body, the role of the local bodies. Obviously, the proposals allow local bodies to make refinements and perhaps refine the pie definition that is suitable for the local context. The question is, would this result in lack of comparability across the globe?
I think that's inevitable once you come to a conclusion that you cannot have a globally applied definition, because anything else implies there's inconsistency or potential inconsistency. Really, we didn't feel there's any way around that. And what we felt was this was an advance on where we were today, because if you like, we're at least giving local bodies a starter for 10 in terms of coming up with a definition, as opposed to today, where it's basically listed entity and anything else that a regulator wants to add in.
Thanks, Mike. Next question relates to the forum of firms. And of course, the member firms of the forum of firms are committed to complying with the IESBA code as part of their membership commitment. So they may not be able to take advantage of local exemptions and from the IESBA definitions. And what is IESBA's intention in terms of for the forum of firms, member firms?
We tried to express the requirements in the code in such a way that it would allow the local definitions to trump the IESBA definitions. It's the one occasion when IESBA has very deliberately chosen a route where, if you like, it's not looking for setting the bar at a certain level and only allowing people to exceed it. So we have said that we expect the firms to look at what is in the local codes in terms of interpreting what's in the IESBA code. If people feel that's not clear enough and they want to suggest additional wording around that, that's fine, but that's definitely the intent. That's not to say, of course, that if local regulators don't do the job properly, that doesn't potentially create a problem. So I do think we would be encouraging all the members of the forum of firms to be helping us in assisting local bodies adopt and adapt and refine this in a sensible fashion.
Thanks, Mike. Next question, there are quite a few questions, so I'm just trying to go through them. So bear with me, everybody. Next question, it's on pension funds. Can you go over pension funds that will be included? And there's a specific example here. How about in the US, the 401k plans where a private company may have for its employees?
And again, it would look at the if you like, the entity which has the 401k plan. And forgive me because I'm not an expert on 401k plans. So if that is controlled by some sort of employer trust that controls the assets within the 401k plan, then yes, we might well expect them to be included in the same way as, for example, a defined benefit pension trust in the UK would be included. If it's merely, if you like, providing access to other arrangements that enable the employee to save for their future, and the employer has, if you like, hasn't got a direct role in controlling or supervising the investments in which the employee invests, then probably not.
Thanks, Mike. Next, we have a question on investment funds. And the question is, was consideration given to the definition of public? For instance, is there consideration given to excluding high net wealth or net worth individuals as public?
I think we were taking a very sort of common view of public. So it's publicly available, I suppose, is more the test than if it's a very narrow class of individuals to whom you make something available. That's arguably not the public, but just because it's high net worth investors per se, I don't think it would necessarily be excluded. If it was selected high net worth investors, then potentially.
Thanks, Mike. And back to the publicly traded entity and also listed entity. The question is, one of the objectives of the project was to establish agreement between IAASB and IESBA on a common revised definition of the term listed entity. How do you think this will be achieved, and will IAASB replace listed entity with publicly traded entity in the standards? I mean, that's probably best to answer by IAASB, but I guess a lot of participants might have the same question today.
I was going to say, I find that quite hard to answer because I don't know what the IAASB will do. Clearly, they understand the objective that we set out to try and achieve. It always was an IESBA project, not a joint project, although, as earlier, we did have very close coordination. So I think it's really now over to the IAASB, who, as I say, have supported us in what we're trying to do. So I'd hope they would pick up some of those ideas and run with them.
Thanks, Mike. And I would add that we've had very close coordination with IAASB, and they are scheduled to look at the listed entity questions plus the other two issues, and we're getting views from our stakeholders as well. So make sure that you put your comments in there as well, and they will consider this as the initial information gathering towards the end of Q2 when the comments come back. Thanks, Mike, for that. Next question is in relation to transparency. If a firm treat an audit client as a PI, as an additional entity that should be treated as PI under our proposal, should they first seek agreement from their audit client?
I don't think it's a question of seeking agreement, because ultimately we are saying this is the firm's determination. Would I expect them to be discussing it with their client? Yes, of course I would. And I would hope they would be pointing out what they would see as the reasons and both the advantages of treating them in that way.
Thanks, Mike. Next question back to auditor's report. Why is there a suggestion or idea of including in the auditor's report whether a company was treated as a PI or not? Is it because of transparency? And even though there is already a definition in the law or regulations that those entities should be treated as PI?
As I think I said in the presentation, I mean, there are really two reasons. We do accept that in order to try and achieve what comparability we can across jurisdictions and between certainly those entities which have been included by firms within particular jurisdictions, it's important that people understand very easily whether something is or is not treated as a PI without having, for example, to go away and look up local legislation. And it seemed to fit well in the audit report from my perspective, I have to say, although ultimately it's IAASB to think about this. But given that there is a requirement now to state that the auditors are independent, I think it's helpful if they also indicate the standards by which that has been assessed.
Thanks, Mike. Next question is, has there been an example of audit failure that the IESBA proposals is trying to fix?
I think that, as I say, that there's been a number of examples of audit failure around the world where, for one reason or another, people have felt it's important to extend the PI definition. That is a practice which is ongoing in a number of jurisdictions, not least of which is the UK at the moment. I think we are being responsive to that perceived need.
Thanks, Mike. Next is more a comment, I think, but I think it's probably good if you could give a response to this as well. It's over the comment. I think it's over time to achieve consistency. It may not be good enough or good enough reason, because in the interim period there will be lots of frictions and arguments amongst firms and clients.
Again, I don't think that's been the experience in the two countries we know which have already adopted that as a requirement. We're certainly not conscious that's been the experience in those countries. And secondly, I think the inconsistency within a jurisdiction between firms is likely to be dwarfed by effectively the inconsistency between jurisdictions in terms of how they apply it, irrespective of how much guidance we give them. I think that is more likely to vary somewhat around the edges, and therefore, as I say, transparency is key in terms of helping inform people to ensure comparability between jurisdictions as well as within jurisdiction.
Thanks, Mike. And we've got time for maybe a couple more questions. Next one I have is, would it be fair to say that the IESBA's approach was guided by the impact of an entity or the interest of individual investors rather than the broader public interest? And there's an example from the UK here. For example, the UK tax structures, example EIS, there would seem to be a genuine public interest in the financial condition.
I'm not sure there is. They've got very restricted numbers of investors. You have to basically be a sophisticated investor in order to sign up for these things in the first place. You have no ability to trade them, so you couldn't make decisions based on the financial statements. Most of them are startups. They are small entities where applying the PI definitions would be probably, I would have said, against the public interest. It's designed to make life easier for these companies as startup operations. I think we have been very conscious of the public interest throughout this project.
Thanks, Mike. And we might have time for just one last question. If an entity has been identified as a PI client during the course of an engagement, what would be the role of the auditor, and how would it impact, say, NAS, the provision of non-assurance services, and the requirement in terms of fee ratio?
Clearly, the application of all those standards would come in, and depending upon what had led to it being treated as a PI where it wasn't previously being treated as a PI, there are obviously transition reliefs when something moves from being a non-PI to a PI.
Okay, thanks, Mike. And that's all the time we have, and we are right on the dot in the 1 hour mark. We have a few more questions, but unfortunately we don't have time to answer all of them. So I want to thank everyone for joining us today on our webinar today, and a special thank you to Mike Ashley, who is of course our PI Task Force Chair and also IESBA member, for his presentation today. We will upload today's webinar to our website shortly, so stay tuned for that. So again, be well and stay healthy, and have a great rest of the day, and thank you for joining us today.